the stock market reaction relative to the dollar and the Treasury bond market reaction, it seems like it was clearly more of a risk-on mood than it was a peace dividend kind of mood. If there was a safe haven bid to the U.S., it was pretty feeble, I guess is my point. When you look at the dollar and Treasury yields, basically barely moved. So it seemed more like a risk on, and maybe that was a function of the fact that the oil market, as you said, rather than being $80, which is what I sort of expected we'd wake up to Monday morning, actually went down. So I think maybe that was it, because obviously if you don't see higher oil prices, that's tremendously supportive for risk assets in terms of lowering the presumably the second largest cost of business is outside of labor. So, that might be it. It could just be, trying to put a positive spin on things. But I do think that in the broad sweep of things, what we've seen is a move by the administration that continues to burnish this shift from the sort of, let's say, globalization move to more of this multipolar, this mercantilist agenda. I think that action, that very aggressive, strong action that the president took over the weekend, sends a signal to Russia and China about any of their malign intents. That the U.S. isn't just going to stand idly by, and that, we're going to take bold action when needed, even though our impulse is not to put boots on the ground anywhere around the world. That doesn't mean that the U.S. is just going to sit back and let China and Russia and other bad actors run.
Something shifted this weekend, and the markets felt it instantly. Stocks leaned into risk, oil prices unexpectedly dropped, and the usual panic signals barely flickered. No rush into safety, no surge in the dollar, no dramatic move in Treasury yields. It's the kind of reaction that raises more questions than answers. Was this confidence or complacency? Because beneath the surface, there's a deeper story unfolding. Energy prices, one of the biggest pressures on global business, suddenly easing when they were expected to spike. A geopolitical flashpoint that didn't spiral, but instead sent a very different kind of message. And a broader shift taking shape, away from globalization and toward a more fragmented, power-driven world order where economic strategy and political force are becoming tightly intertwined. This isn't just about markets reacting, it's about what those reactions reveal.
Rough shot. So that might be another aspect of this that's worth keeping in mind, especially as we move forward and in, I guess, 2 weeks, have the BRICS Plus meeting where Russia and China obviously will be paramount in discussions about the further growth and expansion of their trade relationships and their move toward developing a joint currency or trading currency. So, I'm kind of stringing together a lot of thoughts there, but I do think there is some connection between our national security action and what it means for this whole de-dollarization, globalization theme that we've been talking about every other week now.
Mm-hmm, mm-hmm. All right, so sort of sends an under new management message, right?
Yes.
This isn't the U.S. that you've been used to dealing with, at least for the past 4 years.
Very well said.
Yeah. Okay, so I understand that part. How about is there optimism? And again, I'm just trying to get a sense for why the markets are just so unsinkable right now, despite all this stuff that would normally, we would think, put some sort of risk premium on the markets. One of the big sources of uncertainty this year has been trade and tariffs, and the administration, wanting to restrike all these trade deals with all the major trading partners out there. Does this strengthen America's hand with those negotiations, and is that potentially one of the reasons why things are so buoyant too, where they're like, okay, well, Trump's showing he means business. He's showing he can get the job done. To your point, he's showing he's not going to tolerate, things he doesn't like very often. So maybe that means these other trade deals are going to start getting struck more swiftly because the countries are like, hey, this guy means business.
Right. Well, I think that could definitely be part of it. Another big moving part that we haven't yet discussed, although we're only 30 seconds into this conversation, is the shifting expectations around the Federal Reserve. And I think that's really important. Now that there's more chatter about a July possible rate cut, whereas previously everyone was thinking maybe September, possibly for the earliest. And now we've got 2.5, let's say, Fed governors coming out and saying, we might actually have the rationale to move sooner, as soon as July. So I think that's obviously a huge support under the markets if it looks like the Fed is going to be a little bit more accommodative.
Yeah, I'm curious. Do you think that those dissenters, or I won't call them dissenters, but more dovish people are sort of leaking those or making those comments as a way to sort of signal to the administration, hey, I'm a little bit more friendly than the guy sitting in the chairman's seat?
They may be jockeying for position for the next Fed chairman. Is that what you're hinting at? Yeah, exactly. Like, here are my bona fides. I'm very much in the president's camp. Maybe, very well could be. But we'll see. The Fed has notoriously tried to have consensus, and clearly there isn't a consensus as it stands right now. And Powell seems to be at very direct odds with Bowman and Waller and possibly Goolsbee. And those are three people who, are fairly high profile. So it'll be interesting to see how that all plays out. Obviously, we'll get a lot of data between now and the meeting that will really decide the action. But I continue to believe that, Powell, this is really not about the economic data for him. This is about showing that he has the stones to stand up to Trump and that he's not going to get pushed around. Because there's no question that the case for the Fed to be cutting rates today is better than it was in September. That I'm not an advocate for the Fed intervening in the markets and trying to set the interest rates that the market should be determining, but this is the world in which we live, and if they're going to do that, certainly the rationale for doing it now is much stronger than it was in September. And I think it's not for nothing that the bond market slapped the Fed across the face when they started cutting rates in September, because it was so nakedly political. And again, there wasn't really the economic justification for it. So the bond market vigilantes said, look, we're gonna reverse any stimulus you're trying to inject into the system by exactly offsetting the drop in the Fed funds rate by driving the 10-year yield up in equal measure.
Right.
So we'll see if that happens this time around. I suspect that the bond market probably won't sell off the way it did then, again, because the backdrop is more dovish. But I wouldn't expect to see a dramatic rally either across the Treasury spectrum because of our fiscal situation. And that's another aspect of this, Middle East situation and our involvement there. Is it certainly puts paid to the idea that we're going to have any reduction in spending, as particularly as relates to one of the biggest components, which is defense spending.
Right.
Yeah.
Which already was getting increased too.
Yes.
So before this, the defense was getting its unfair share. All right. So number of different things. First and foremost, folks, just let us know where you're watching from or something in the live chat here. The live chat seems real quiet this morning. I just want to make sure it's working. Also, from some of the few comments in there, I just want to note the dog in the back of the room is not dead. She's just sleep. She's a champion sleeper. She's
already had a puppuccino and a 10-minute walk this morning. So she's wiped out. It's been a big day.
Okay. All right, good. I do see folks posting here. So thank you. In just a sec, Steph, I want to get to what's going on with student loans because it's tied into really some of the weakness that we're seeing in the economy, but basically it ties into.
The markets look calm, but underneath something big is shifting. While headlines talk about stability, the real story is a quiet power struggle unfolding across global trade, central banks, and geopolitics. From rising BRICS ambitions to whispers of a new trading currency, from escalating defense spending to a Federal Reserve that may be pivoting sooner than expected, none of this should feel normal. And yet, markets keep pushing higher. So what are they seeing that most people aren't? Is this confidence or complacency? Because when you connect the dots between political pressure on interest rates, fragile global alliances, and a system still heavily dependent on debt, you start to see a very different picture. One where every move, every signal carries consequences far beyond the headlines.
Inflation is a component that ties into inflation, but probably an increasingly important one. And I know, a lot of your analysis right now is saying, hey, folks, inflation worries are likely to be very overblown at this point in time, and we should be worried more about the disinflationary forces that are slowing the economy. Real quick, just on Powell, I totally get what you're saying, and I just want to clarify to get your opinion, and I know you're just guessing. So if Powell is really trying to underscore the Fed's independence, hey, I'm not going to let the president push me around, is that, and forgive the pun here, it's not intentional, but is that trumping him doing the right thing? Like, you can make an argument he made a political decision, back in September. Can you make an argument now that he's making an egotistical one that is not in the interest of what the Fed should be doing?
Absolutely. I mean, again, I am not a proponent of the Fed intervening here, but if they're going to be active in the markets, it makes much more sense for them to be doing it now than it did in September. And so, if inflation is definitely decelerating and the run rate is even slower, and we're clearly seeing some weakness on the employment side, and those are their two mandates. I think as ever, Trump will be right for calling Powell too late in his, definition of too late. I mean, clearly, the slowdown is really in train. We just got the Duke University CFO survey out. And again, it was a very downbeat assessment from CFOs about the uncertainty, and they're very concerned about tariffs and the impact it will have on their margins. And so they're really restraining CapEx and by extension, hiring. So this is an environment where I guess, if you're a proponent of Fed, intervening, then this would be the time for them to do it. But again, I do think, yes, Powell will probably dig in his heels, just from an egotistical or political standpoint, either way, at a time when the case for cutting is certainly stronger than it was when he was cutting.
Yeah. All right. And I'll try to
tell. You can tell I'm very much milquetoast about the Fed doing anything right now. I mean, I just feel like the Fed is the problem. It's not the solution. And their history has demonstrated that. So, I'm pretty soft on pushing the idea that they should be cutting rates. But again, my point is simply, if there was a case to cut rates in September, there's a much, much, much stronger case for them to be cutting rates today.
Right. No, I get it. And I share your general position, which is, hey, don't intervene. But if you're going to